Hi, everyone, and welcome to the fall 2023 commentary with Martin and I. All of you know me, Bob Thompson, head up Thompson Investment Partners. And this month, Martin and I will be chatting about markets again. Hopefully, in the future, I'll get some other members of the team on the calls too to enlighten you what Tanya does and Minhei and Alexia when she comes back. But for now, Martin and I, let's chat about markets. It's September, October, and we got some volatility as was expected.
Yeah, definitely, Bob. I'm happy to join you again. And today we want to go over a number of things. The first one, of course, is what's been happening in markets lately. The second is how have rates and inflation impacted the economy? Third is, how are we positioned and has our approach changed at all this year? And lastly, pretty excitingly, we want to talk about the Thompson Learning Academy, which is a series of articles and a webinar series also to enhance the financial competency of all of our clients, young and adult children. So let's dive into it. September, like you said, is typically one of the worst months for markets historically. So no one should really be surprised at the volatility as it usually passes in October, and we may have seen this happen already. However, we understand it hasn't felt that way over the last few years. The last 2.5 years, markets have just been chopping sideways,
Mhm.
have been quite volatile. And even over that period of time, while markets are relatively flat, bonds are down over 10%. So we understand that certain investors might feel a certain way. So with that being said, we're pretty happy about how we've managed portfolios over this period of time, you know, providing some strong gains and cash flows. And with that, let's dive in. Bob, can you touch on why markets have pulled back lately?
Sure. A few months ago, Martin, and we've been kind of talking about it, sound like a broken record, but how markets don't do well when interest rates rise. And there's an old expression, don't fight the Fed, right? And what that means is the Fed's raising interest rates a lot. Usually the markets pull back or don't do anything for a while. Now, I think a lot of us were surprised at how much the interest rates were raised this cycle, and there's some reasons around that we can talk about. But the fact is that interest rates have gone up faster than they have in almost any other time frame that you look at, and that's put pressure on lots of different areas of the market. And I think what's kind of a little bit different this time is that bonds have been hit pretty hard too, right? And when bonds go up or bonds get hit hard, and the bond market's a little bit independent of what the Fed's doing, right? The Fed raises short-term rates. The bond market adjusts in various manners, but the 10-year bond in the US here in Canada is kind of the thing that makes the economy go, right? Mortgages, debt payments, et cetera, rolling over debt. And that's gone from 1 to 5%. That's a massive rise. And it hasn't had a lot of implications for the economy yet, but it probably will going forward. One of the things I talked about a few months ago is that it's strange how it works, but market events tend to manifest themselves in September, October. Maybe one of the reasons is that summertime, lots of people are on vacation and away and on the beach and doing things other than markets, even people in our industry. So you don't see a lot of these market moves. But then people come back in September, and then bad news starts to flow into the market. And as you mentioned, September is the worst month of the year for the market generally. Not always the case. As soon as you bet that that's going to happen, it won't be. It'll be a great year. But we tend to be a little more cautious this time of year and into October. And September was a pretty rough month for bonds, especially, and for stocks also. But throughout our portfolios, we were defensive. We had lots of cash, and I think we managed to keep losses to around 2.5%, which I was really happy with considering all the things that were happening in the market.
Yeah, exactly. And then if we bring it to the economy, a lot of people are looking at the market and wondering why is the market pulling back when the economy's been holding up? The jobs report's been relatively positive, but that's what it looks like on the surface. Underneath, you can see that there's actually some cracks. If you look at the jobs reports, you can see that a lot of those increases are coming from part-time employment. And one can speculate why people are taking on more part-time jobs. It could be to pay for that mortgage, it could be to make ends meet in other different ways. But the stock market's usually the best leading indicator for things to come. And that's where we're actually seeing certain things break down as a result of those higher interest rates that you mentioned. That could be the consumer, as spending has shifted a lot from, discretionary items during the pandemic. A lot of people were, buying boats and other nice things as interest rates were at zero, but now interest rates are at 5%, and they're focusing on what they need, their rent, their food, and other staples in their lives. So let's dive into some charts to highlight a few of the cracks that interest rates are
And
causing today.
and just to comment as you're pulling up the chart there, Martin, 50 years ago, people all had full-time jobs. There wasn't really a lot of part-time jobs around except for kids or whatever the case was. But, case in point, everybody's an Uber driver these days, right? Supplement your income and you can do it whenever you want to, work as many hours or less hours as you want. And there's a lot of those sort of jobs around. So is the employment picture that great when people have to take on extra jobs? Not necessarily. But I think the numbers are skewed to a degree. There's a tremendous amount of people on disability now, especially since COVID, and they haven't come off of disability. They're not in the workforce. People are retiring. And speaking of 50 years ago, um, the 70s was a time which a lot of clients will remember: high inflation, higher interest rates in the late 70s. And I think one of the reasons why they've raised interest rates so fast this time is because they're desperately afraid of having another 70s type scenario where you get these uh, um, inflationary bouts caused by lots of extraneous events in the world, which causes wages to go up, which causes more inflation, et cetera. And having said that, interestingly enough, we've had a, a tough situation here in the last few days in the Middle East. And it was a situation very similar to this, actually, which started the 70s inflation cycle in 1973, 74. There was a similar sort of event that was happening right now, and it created an inflationary cycle for the 70s. And we're obviously keeping our eye on that.
Well, let's bring it back to Canada. So I'm just going to bring up a screen right here. And the first chart we have is Canadian consumer confidence. And you can see that it's deteriorated. And you've commented on this already in terms of a lot of the reasons why are interest rates and inflation. But I'll let you dive a little bit further.
Sure, any number below 50 on this chart, and I realize it's a complicated chart, kind of tells you that consumers are not very excited about their near-term financial future. So you see that drop off in 2020 pretty substantially. They came back quickly because there was lots of money printing and free money given out by governments, etc. Right now, a drop has happened, and it's similar to what it was in mid 2022, and it varies around a little bit. But I do think that people aren't feeling as confident about the future, and if they aren't, they don't spend, right? I mean, the United States, 70% of their economy is consumers. So if consumers aren't spending, it hurts the economy. Here in Canada, it's not as bad, but Canadians have a different situation, and that is, high mortgage payments, etc. And people are not feeling like they can go out and spend a lot of money. And it's interesting because you can get some real-time information, which this one tends to be, right? People aren't going to spend as much if they're not as confident. But you can get real-time information, when Costco comes out and says people are spending money on chicken rather than beef. They've switched from beef to chicken. Well, chicken's cheaper than beef. There's a reason for that because they're feeling financially pinched.
Yeah, and that's showing up in other areas. And I'll bring up the second chart, which is, the Canadian Bank Index over the last 5 years. I'll let you dive into this.
You know, um, we haven't been positive on banks for a while, and throughout our model portfolios, we don't own bank stocks, which is highly unusual in Canada because, a lot of Canadian institutions just buy bank stocks blindly for clients and because they've raised their dividends, et cetera, over the years. But, you know, bank profits are getting squeezed, and we're starting to see that now. We've been, as I said, negative on banks for a long time. But if you look at that chart, they're about the same as they were in price 5 years ago. right? So they haven't done a lot, and the market kind of sees that banks are getting squeezed. That doesn't mean that banks are going to go bankrupt or they're not going to be in business or anything like that. So don't worry about that. But what it does mean is their profits are getting squeezed, and that's being reflected in the stocks. Or the market is expecting the profits to get squeezed. And when you hear that 20% of the big three banks, their mortgages are negatively amortizing, means that the interest payments aren't even keeping up with the mortgages, then that's a problem, right? And that's gonna be a problem for the banks. And what you've highlighted on this chart here is when markets kind of break down, you usually see some levels here, and this is a perfect chart because you see 4 or 5 times there the banks have touched that blue line, right? And all of a sudden it's dropped down through that blue line. And this is important in markets because that generally means that a breakdown's occurred, and there's some more downside definitely for the banks. Again, not a problem for your money in the bank or anything like that. It just means the profits of these banks are probably going to get squeezed, and there's going to be some mortgage issues going forward here.
Yeah, exactly. A lot of people took a lot of debt on during the pandemic. Like I said, they might have bought bought a house, and they
Hmm.
bought it at very low rates, and they were competing with other individuals, so they spent a
Right.
lot more than they thought they would spend. Well, rates went up, and now, it's tough servicing those higher debt loads, and I think the banks are the ones that are admitting that that's the case by extending those mortgages out for a lot of people and just allowing them to pay interest a little bit more to make those ends meet. So we'll see what comes of that. But on our last chart here, we want to focus on the Canadian REIT index, which has seen a lot more pain over the last 2 years than the bank stocks have. So let's talk about this a little bit.
And remember, REITs stand for Real Estate Investment Trust, so it's kind of a way to buy into real estate in a liquid manner. In other words, you can buy and sell REITs on the market any day, but they hold a portfolio of real estate, whether it's commercial real estate or malls or industrial or apartments or whatever the case is. And sure, this was a no-brainer for many years. Did extremely well in Canada, and obviously it's come under a lot of pressure here. And one thing to remember is when the market usually things go down on the market before the fundamentals are obvious, right? So we haven't seen the fundamentals worsen in a lot of these things yet, but the market is already showing that the fundamentals are going to worsen. And that's why it's really important. And I always say, you know, when everybody's worried about something, you probably shouldn't be worried about it because the market's already reflected it. When nobody's worried about something, you should be worried about it. That's right. So that's why when nobody was worried about kind of a lot of these assets and the bank stocks and things like that in the last couple of years, we were a little worried about them, right? But these will get to levels that become attractive down the road. But you can see from this chart that obviously the REIT index, whether it's the apartments or industrial or commercial, is under some pressure, and it probably will continue to be. One of the reasons for that is the interest rate increase, obviously. Real estate goes down when interest rates go up. It's a fairly simple formula, unless you have extra factors in the market. So I think that's something to be aware of. Real estate is a huge part of the Canadian economy, and it's something that we have to be aware of. When people can't continue to leverage and they have to deleverage, that affects lots of different areas.
Yeah, exactly. And just to add on what you were talking about, usually I heard a great quote the other day that said, when something becomes headline news, you shouldn't trade on it unless you fade it, unless you do the opposite,
Hmm.
because that's when it's hitting the economy, the market's already reflected it, and it's likely going to be an opportunity. And I think REITs are probably coming closer to an
Hmm.
opportunity than the banks are. And we'll see in terms of where their yields are, what they're paying. There definitely are some quality ones within the group that are getting dragged down that are worth looking at soon. So let's bring it back to our portfolios. How are we positioned today?
And you bring up a great point, Martin, because interest rates have been headlines for the past month. Interest rates have been soaring, they've been going up.
Mhm.
And I've just been waiting for that sentiment to slow down because you don't want to follow that, right? That was already factored in the market. It's old news. So when somebody or the press starts talking about something in extreme detail, usually you're good to take the other side because 3 months from the point of maximum pressure, it
Hmm.
usually isn't an issue anymore. And we saw this with the US dollar last year, right? Peaked, right? And bonds peaked. And then it was great for a few months. Okay, now we've had that again. So don't get caught up in the news and stay away from what the headlines are saying because they're usually trailing indicators. They tell you what just happened, what's not going to happen. So from that perspective, what are we doing in the portfolio as well? I think we have a pretty good opportunity right now because there's some great businesses out there that are outside of the financial sector that pay very, very big dividends, right? So stocks like Bell Canada, because the stock has come down, when interest rates go up, stocks that pay high dividends go down in price. That's just a simple formula again, just like real estate and interest rates. So Bell Canada has come down to a price where it's paying a 7.5% dividend, right? So you get a 5% in a GIC, but you're paying half your money in tax, half of it in tax. So they're only making 2.5%. But in great quality companies like Bell Canada, Enbridge, et cetera, you can make 7 or 8% dividends now. And these stocks have come down a lot. So I think those are bargains, and those are things we're starting to add. We had in the portfolio, and we're starting to add more into the portfolio. So what we do, Martin and I sit down and we decide what stocks we want to buy, what prices, when we would be interested in buying them. So a stock like BCE, we say, okay, it's 2% of the portfolio. We want to have it as 4% of the portfolio. For example, let's see the time when we're going to do that. At what price do we want to do that? So that's starting to kick in right now where stocks like that are becoming pretty attractive to us, outside the financial sector, right? So some of the utilities, some of the telecoms, these sorts of companies. Other sectors, I know we've talked about this for a long time. We don't have a lot of allocation in the portfolios, but we might increase it as the gold sector. That sector does the best when the Fed pauses, when interest rates pause and they start to go down. And we're right at that time. We might not be in the ninth inning, but we're in the eighth inning or the seventh, bottom of the seventh. We're getting close to that interest rate cycle being over. And once that happens, gold usually does very well, and the gold stocks do extremely well after that. We also, usually going into some sort of recession, and we think there's going to be some sort of recession that happens. It usually happens about 20 months after they start to increase interest rates. So, everybody thought at 7 or 8 or 9 months, oh, we're going to have a recession, and then it didn't happen. So suddenly after 17 months, everybody's saying, oh, no recession. We're all good then. Well, it doesn't even normally happen until the next 6 months from now. So we still got our eye on that. What's going to do well in those environments? Bonds do well in those environments, right? So we've been buying more bonds in the portfolio. The yield on the bonds is high right now, right? There a lot of bonds are paying, risk-free bonds are paying 5. So you got 6 and 7% bond returns in the portfolio. And of course, if interest rates go down, you get a capital gain on the bonds when they come down. Generally, recessions are caused by oil prices surging at the end of a cycle. We started to see oil prices put that pressure on. If we get another surge in oil prices, it'll definitely slow down the economy. Other sectors that we like, value sectors. So value stocks are stocks that are not highly leveraged, right? They have good, stable cash flows. They don't have a lot of debt. And if they don't have a lot of debt, they can get through these higher interest rate cycles, and they tend to be more depressed in price. So value stocks are things we're going to look at, and I think that's a longer term trend for value stocks. And the last thing, we haven't been extremely active for a long time. I once heard just because the market trades every day doesn't mean you have to do something every day. If there's nothing to do, don't do anything. So we've been letting cash build up in accounts. A lot of accounts have 20% cash now, and you got to have that cash to spend when there's good opportunities. And cash is doing okay for people right now, but we're gonna spend that when the time is right. And one of the things we've been kind of using that cash for in the last little while is these structured notes. And in this interest rate environment, a lot of these notes are paying, 9, 10, 11%. They're backed by the bank, and they give you some degree of capital protection on the downside. So those are great things that get you through a bad market. A nice 7.5% dividend is a great cushion to have on a stock to get you through a tougher market, and some of the alternative investments that we've been using also.
Yeah, and to sum it all up, I think it's perfectly said by saying that we were disciplined and patient throughout the year. We didn't go out and chase what everyone else is chasing, whether that's tech stocks or anything else, because there's a lot of areas that have been hit in the market. So you really have to do your homework. It's not always easy to be patient, but I'm pretty pleased at
Mhm.
how we've navigated it and avoided certain risky areas. And now we set up the portfolio with a good cash position for continued success moving forward. So, lastly, I just want to discuss the Thompson Learning Academy. What we've done is we've created a series of booklets for every different age group, ranging all the way from young children to adults. And each booklet has a series of articles that will increase their financial competency in a variety of different areas. It could be from starting a business, something that complex, to something as simple as budgeting. So we're really excited to launch that as well as a webinar series. So we'll be sending out an email with more information on that in the coming weeks. So please stay tuned for that. And otherwise, I want to leave it to you, Bob, to see if you have anything to say at the end of this.
Not really. I think things are working out, as expected. We always have to be, cautious in these sorts of times, but there's lots of cash and we have that there to take advantage of opportunities because that's how you do well over time. The problem is, generally speaking, people don't have cash at the right time.
Hmm.
We've made sure there is cash in order to take advantage of things.
Well, great. Thanks a lot and really appreciate it. And if any client has any questions, please get back to us, throw out an email or give us a call. We're always here. Appreciate your time today, Bob, and we look forward to updating you on the next one.
Fantastic. Thanks, Martin.
Bye.